Yo, what's up, everyone? I'm Nathan Robert, and this is my last stock portfolio update as a 20-year-old. So, next week, I actually turn 21. I'm going to be out of town. So, I thought I'll go ahead and do a stock portfolio update right now. And I'm mainly going to share with you why I own every single stock that I do. I'm going to tell you a little bit about the company. I'll also share with you my Roth IRA and my Moo portfolio over here. So, yeah, I'd appreciate as an early birthday present if you drop a like on the video for me. I'd appreciate that. And let me know in the comments your honest thoughts on this. And yeah, let's go ahead and get straight into the update. And check this out. Year to date, we're actually down 8.5%. And look at us the past year. We are only up 2% the past year. I mean, if we compare that to the S&P 500, for example, well, I guess they're only up 3.83%. So we've slightly underperformed the S&P 500. So I'm actually okay with that. And here's our total percent change on every single stock. So the only stock we're down on right now is Google and United Rentals, or at least in this portfolio. We're down on some other stocks, but I'm going to go with my largest holdings first. So I'm going to start up here with ticker symbol CSL. I'm going to tell you about why I like them. You've probably never heard of this company before. They actually have 48 years of dividend growth. So they're super close to being a dividend king, but I mainly love this company because of their stock buybacks. This company has literally bought back 8% of all the shares that exist just in the past year. So you technically own 8% more of the company than you did 1 year ago, thanks to the buybacks, on top of the 1% dividend yield you get here. So we're only up 4.64% on them, but they're my largest holding. They repair roofs. It's actually a little bit recession resistant. If even if you're in a recession and you have a leak in your roof, you're going to repair that. They mainly repair commercial roofs, so not like residential. Only like 25% of the revenue comes from residential. Their stock price trades at like the home builders do, but they're not a home builder at all, but they trade like them. All right, so my second largest holding here is McDonald's, and I absolutely love this company. They're not just a restaurant, they're actually a royalty and real estate company. Whenever you go spend $100 at any McDonald's, a 4% sales and marketing royalty goes back to this stock right here, the parent company. And over 85% of all the McDonald's land is owned by the McDonald's parent company, this stock right here. And so every tenant is also or every franchise is also a tenant. They pay rent and royalties to this parent company right here. Anyway, you get a 2.5% qualified dividend with McDonald's. They're known to be recession resilient. Look at this in 2008. This is so impressive. The stock didn't fall in 2008, so that's what's so cool about them. And we can also see my dividend history down here. Yeah, we just got a $23 dividend from McDonald's, which is kind of cool. And looks like Morningstar has us at a $308 stock. But have y'all heard of the McDonald's Minecraft meal deal? It's absolutely huge right now. So much free marketing for it. This is another company that buys back their own stock like crazy. So you get a 2.5% dividend yield, another roughly 2% in stock buybacks, and then they have 2% same store sales growth. So, not financial advice, nothing in this is, but you should just get 7 to 8% of your money back every year with McDonald's. It's safe, it's recession resistant, but it won't outperform the S&P 500 or like the QQQ. It's not, super growthy or tech. It's so reliable, it's a staple. So anyway, that's McDonald's. This next stock here is ticker symbol CEG, Constellation Energy. They have a huge nuclear energy business. They actually own 50% of all the US nuclear energy reactors. So they're the largest pure play for nuclear energy, and they're also in the natural gas business. Our actual natural gas bill at our house is through Constellation Energy. So we're also kind of like a customer. And hey, look at this. I'm only up 1.23% on this company. The valuation is pretty fair. Oh yeah, Robinhood has the PE. It's a 17.5 PE ratio. You get a 0.7% dividend yield, so nothing too crazy. But yeah, $65 billion company. They haven't even been public for 5 years. But yeah, I own this company for a reason. It's my exposure to utilities and nuclear energy and, data centers. I believe nuclear is really going to be the future. It's the cleanest form of energy. They also own some hydroelectric plants. They own some geothermal plants. They actually supply 20% of California's clean energy just from one geothermal plant from Constellation Energy, which is really impressive. Anyway, let me show you this next stock right here. We've all probably heard of this company before, but yeah, this is such an innovative company now. I'm down 3.3% on Google, but I absolutely love this company. I just keep buying the dip on them. We just had a little dividend, $2.80. But yeah, the thing is, Google owns so many businesses inside one, and they're trading at historically a super low PE ratio. The PE is a 19.82. They're now paying a dividend, a 0.5% dividend, but they own YouTube, they own Android, the Google Play Store. Whenever you buy something in the Google Play Store, Google takes a 30% fee on it, kind of like Apple does. They own Waymo, they have their own quantum chip. The Google Cloud business is huge. They just acquired Wiz for 30 billion, so they're in cybersecurity now. So Google is such an innovative growth company. I don't know what's going to happen with the Google Chrome split off, but even if that has to get sold off or something, the valuation is fair here. They're making actually, I can say this for certain. Google's going to make over 100 billion of net income from now on every single year. So that's just phenomenal. We all know Google's great. So I won't spend too much more time on them. But this next stock here is one of my most recent buys here in my Robinhood portfolio. We're down 2.5% on them. And I don't really have much to say. You just rent things from this company. Like you can rent forklifts, porta potties. I just came back from North Carolina. I saw so many United rental stuff on the side of the road. You can rent trucks from them, forklifts, just pretty much anything, huge tractors. So I'm down 2.56% of this company, but this is a huge stock buyback play. They literally buy back 3% of the company every single year, pretty much no matter what. And look at the dividend. You get a 1.15% dividend on top of that. So you get a 3% buyback yield, 1% dividend yield. So you just get 4% of your money back just from the company returning money to the shareholder. And the valuation is pretty fair, a 15 PE, 15 times net income. So that's what's pretty cool. Does Morningstar have anything? They say this stock is a $590 stock. They have no economic moat, which I can kind of agree with. They have a nice little synergistic, platform network digital experience where what's it called? The warranty. They have a nice little warranty program. I've looked into them, but anyway, they're not a huge position. $2,300. This next stock right here is Meta Platforms. 3.35 billion daily active users is super impressive for this company. I am up 9% on Meta, but I actually poorly timed my most recent share purchase. Look at that. I bought a share on February 28th at $659. And currently Meta is 542. You can see at the top middle there. But yeah, you can kind of see the dividend history right here. I can't wait to see the dividend growth behind Meta. As I just accumulate more shares and they naturally grow the dividend. Their payout ratio is extremely low. They literally could, if they wanted to, 3x the dividend, but choose not to. That's their stock buyback program is insane as well. So yeah, I really like Meta. They own WhatsApp, Instagram, Facebook, and they just make so much from ads. So this next stock right here is ticker symbol CRM. This is Salesforce right here. They own Slack. Oh, look at that. We have a pending dividend of $3.33, which is kind of cool. But yeah, we're up 9% on our Salesforce shares as well. We only got 8 shares. This is our smallest holding now here in our portfolio. It's just for $2,000. But yeah, they're huge in sales, marketing, analytics, data, customer relations, CRM. Yeah. So anyway, Robinhood, that's our portfolio here. I'll be really quick about our Roth IRA because it's only $700. But yeah, we have 10 shares of ticker symbol INOD. I'm not putting a lot of money into this stock just because they're so risky. And then I also have Kroger. This is just a grocery store. They're kind of like a smaller version of Walmart here in the US. And I absolutely love this stock. But the coolest part about Kroger is that even if you buy the stock right now, you get a 1.8% dividend yield and the PE ratio is an 18. So the valuation is really fair for Kroger. So anyway, that's why I own them. Only $300, but I really plan to add more to my Kroger position. And I also plan to add some more ETFs in my Roth IRA. So yeah, that was our Robinhood portfolio. Now I want to go over my entire Moomoo portfolio and share with you every stock that I own in here. But first I want to show you how this portfolio has performed year to date. So on return money weighted, we are actually down 7.39%. And it says down here the S&P 500 is down 8.61. So we're actually down a little bit less than the market. So let me go ahead and share with you every stock that we own in here. We'll start with the largest stock first. So this is Comfort Systems right here. I've literally put my entire position in this stock just in the past couple weeks here. They started to trade at a very fair valuation. They literally just repair HVAC systems. They're a mechanical and electrical company. So 78% of their revenue comes from mechanical, 21% electrical. They also do plumbing. So the PE is pretty fair. They're trading at 23 times PE. And the fundamentals are everything's growing. The revenue's up 37, the net income's up 59%. So that means they're growing their net margin. The free cash flow is up 14%. So this is just an incredible growth company trading at a pretty fair valuation. They also have 14 years of dividend growth. You won't believe the dividend growth on this company. I mean, the yield right now is super tiny. That's just because the stock has appreciated so much, but they have a super low payout ratio. I really love Comfort Systems. So this next stock right here is Powell Industries. Now, this company is so unique and so niche. They have such a low valuation. If you look in the top right, the market cap, this is a $2 billion company. And to the left of that's the PE. They're trading at a 13 times net income. And that's what's crazy. And on top of that, they have no debt whatsoever. This is a completely debt-free company. And let's see how much cash they have real quick. So they have no debt whatsoever, and they have $373 million of cash. So literally 15% of their company is just the cash on hand. So you can subtract 15% from the PE ratio. So they're really trading at like 11 and a half times net income. So the valuation's super fair, and the net income is growing. This is just a growing company. Net income's up 44. The sales are up 24. They're growing their net margin as well. Look at that. Net margin's up 16% year over year. So Powell Industries, low valuation, nice growth. They're in the electrical and mechanical business as well. They actually make switch gears. But yeah, they service and maintenance a lot of big service projects. But this next stock right here, we've all probably heard of this company right here. This is Amazon. This is another one. I've just recently put my entire position in this stock right here. I never owned them before the past couple weeks here. So what I love about Amazon is they're just such a growth company. Look at this. 38% of their business comes from their online stores like Amazon. Then their third-party seller services. If you sell something on Amazon, Amazon will take some fees from you. So that's 23% of their business. And they have the AWS, Amazon Web Services. This is the most valuable part of Amazon. It brings the most bottom line to them. And look at the annual revenue. It's now over $100 billion of revenue for Amazon, which is incredible. You know, they own Twitch, so they're also an advertising business. 9% of the revenue comes from advertising. 4% comes from their physical stores. They own Whole Foods. And then the subscription service. Whenever you buy Amazon Prime, that's all revenue for them. And look at the bottom line here, the net income. They made 20 billion of net income just in the most recent quarter. I mean, that's so impressive. And here's what's so impressive about Amazon is how much they reinvest into the company to get this growth. Their cash from operating activities was 45 billion, and their cash from investing activities was negative 37 billion. They're investing so much into the future, and they can do that because they don't have to pay a dividend. They're not doing any share buybacks really. They're just reinvesting in the future, and I do like that about Amazon. And this next stock right here is one I've been absolutely dollar cost averaging into. You know, I recommend if you want to buy a stock, you just slowly dollar cost average into them. Don't spend all your money at once. And that rule has been especially true the past couple weeks. I mean, look at this. Even if you dollar cost average into a stock, though, make sure you're buying a high quality stock. You never know what could happen. Stay diversified. Again, none of this is financial advice. But let me go back to CubeSmart right here. This is my highest yielding dividend stock. So they actually have a 5.44% dividend yield. But if you look at the payout ratio, it actually says 119%. That's actually not true because they actually look at the net income. And for real estate investment trust, you don't look at the net income. You actually look at the net income plus the depreciation and the amortization. And that's called core FFO. And so it says they made 100 million of net income. Well, they actually made 164 million of CFO, which is the number you really want to do a dividend payout ratio from. And when we look at it from that stance, they actually have a healthy 80% payout ratio where they even have a slight bit of room to raise their dividend if they wanted to. So yeah, that's kind of my bet on the real estate investment trust. They're also in the self-storage industry. They own self-storage, and self-storage is recession resistant. And if inflation comes back, I don't think inflation's coming back, but if it does, CubeSmart is easily able to raise their prices because they're month-to-month leased. Anyway, this next stock right here is a very niche company. This is Amphenol Group, and let me just show you where the revenue comes from. It's from three main segments. They're in communication solutions. They make these insane internet cables, super thick cables, super high quality. They're also in the harsh environment solutions. I'm not actually too sure what this is, but look at the business. It's up 39% year over year. I went on their investor relations, like 9% of the company comes from aerospace. So they have some exposure to the aerospace industry. Interconnected sensor technology, that's only up 4%. But look at the communications revenue. It is up 43% year over year. So communications revenue is up like crazy, and their harsh environment solutions is up 39%. So I love the growth on this company and also the dividend growth. And I get the yield's only at 0.84%, but they're so committed to raising the dividend. And the growth here is just so phenomenal. If you look at the orange line right here, the revenue is just expected to keep on growing. By the way, this app right here is called Moo. If you want to download it, it's in the link in the description. It's an affiliate link, so if you deposit $100, we'll both get some free stocks. Look at how they consistently beat on their EPS. Look, they beat on net income, which is EPS. They beat on their EBITDA. The net income was up 44%. What were the sales up? Sales were up 29%. So yeah, they grew their net margin 12%. Amphenol Group is such a cool company. I only have 23 shares in them, but I do want to increase my position in them, especially if I go back negative on them. I don't expect really this position to go back red. Yeah, I bought another share down here at 58, but anything could happen. So yeah, that's Amphenol Group. This next stock right here is DocuSign. So this is one of our oldest stocks we bought. We bought them in October 2023. So I really love DocuSign, but I would not, not financial advice. I wouldn't buy this company right here and right now. The growth is just a little too slow. I bought them at the time because the valuation was just so low. But look at the revenue; it's only up 8.9%. They're not growing their sales that much, but I do love the net income growth. Like, look at the operating profit now; they're making a lot of operating profit, and they had a. I'm looking at the operating profit because they had a huge one-time adjustment. See how this says they made 800 million of net income? That's actually not true. They only made 58 million that quarter, but it's still up like crazy from the previous year because they used to burn money every quarter. Well, now they're consistently making net income every quarter. They also have no debt at all. DocuSign's a debt-free company, so they're investing in the future. They just bought a company called Lexion, which is pretty cool. And the very last stock right here, our biggest loser pretty much, this is Perion Network. This company is just too cheap to sell. If you look in the top right, the market cap, this whole company is worth $355 million. Well, check this out. If you go to their cash on hand, they actually have 373 million of cash. So they pretty much have more cash than their whole market cap, but they also completely lost their growth. This is when I was buying the company. I was like, wow, they're making 20 to 30, 40 million of net income a quarter. Well, now look at it. It sometimes even went negative. They only made 3, 4 million. The sales have absolutely collapsed. They've lost all growth. Sales are down 44%. They lost a contract with Microsoft and their search engine Bing. So yeah, that's the bad news about Perion Network. But yeah, hopefully you appreciate this stock portfolio update. Again, I'd really appreciate if you drop a like for me, and I'll make sure to respond to every comment. I won't usually mention my age again because whenever I mention that I'm 20 years old, I literally see in the statistics like people click off the videos. So I really appreciate y'all being here. I just want people to, treat me like they would treat anyone else. So anyway, hope you have a great rest of your day. My name is Nathan Robert. I'll see you in the next one.